Hi everyone. Welcome to another special edition and a special edition of F.I.P free tutorials. Today is going to be very important because we'll be talking about the quarterly shift using the interbank price delivery algorithm and to see how that has been really impactful within the first 3 months of 2025. So let's give a few moments for people to hop in before we get started with the classes. And all right, let's go.
I'm in SCPQ.
Your mic is mute. We cannot hear you.
Oh, sorry, guys. Sorry. So, what was I saying? I was like, first and foremostly, I'd like to thank each and every one of you guys for showing up today in a very short notice. I appreciate each and every one of you guys for being here today. And this is going to be a very, very fruitful conversation that we're going to have today in regards to liquidity, quarterly shift, open float, new week open gap, and new day open gap. That's the definition of and walk and dog, right? So first and foremostly, would like to ask like, okay, what is the definition of liquidity, right? These markets are controlled by liquidity, and the liquidity is your capital, my capital, the hedge fund capital, the private investors' capital, the people that trade in this market on a daily basis, and this liquidity resides on the previous high and the previous low of the day in the market, right? And they are your stops, they are my stops, they are the institution stops that are residing above old highs and below old lows. Sometimes at the mitigation block, sometimes at the breaker block, because most of the time that's where this institution offload either their bearish or their bullish position before the market continues the overall direction of bias that it was supposed to fulfill after market manipulation, right? Now, what is the definition of liquidity? Liquidity refers to the degree to which a market asset or security can be quickly bought or sold in the market without affecting the asset's price, right? Now, this is what I was explaining here. Now, on UJ, we've experienced a downtrend since the beginning of the first quarter. And we call that here live on our free channel where we had a conversation at the beginning of the year, and we're expecting you to collapse aggressively for the first 3 months. Now, having an understanding the interbank price delivery algorithm as an edge gives you a bigger picture of 3 months market distribution that you could use to capitalize from and trade, casting forward where you think the market is more liable to deliver within a specific duration or a specific period of time. Now, having this edge is very important as a trader because it gives you an insight on which directional bias you should be trading within the next 3 months. But sometimes these directional bias could be fulfilled with an aggressive news that will help push this market towards this direction like very quickly in a single month, but it would have delivered what it accumulated for the past quarter. So understanding these little details actually plays a vital role on how long or the duration with which it can take you for the previous look back of the interbank price delivery data provided 3 months prior to the new beginning of the first quarter would provide. You'll be able to cast forward 60 days to 40 days to 20 days ahead where you think the market is more liable to deliver to. Now, this is very, very important. I can even really emphasize more on this because if you understand these, it gives you an edge to this market more than 70 to 80% of the individuals that trade this market every single day. Because let's take an example on USD JPY, right? USD JPY collapsed since this is December 23rd. Okay, now we are 1st and 2nd of January. 1st and 2nd of January, this is where the market started. I can take a vertical line and place it here. No. We'll put a vertical line here, right? Now, this is the beginning of the year, and the beginning of the year has been entirely bearish. Now USD started bearishly, and we already saw this coming. That's why I actually set a sell position in UJ that was a swing position, or you could actually intraday trade it or whatever it is, but you could actually scalp it trading for or looking for more sell opportunities than buy sell opportunities, because we had a bigger picture at hand, and we understood that the market will have more sell side liquidity to run and more moves looking for sell opportunity than focalizing on buy opportunities, because the buy opportunities would just be a retracement towards a previous bearish open float, or a previous bearish order block, or a previous bearish a previous um buy stop or liquidity run above an old previous high that it must have created before the new low is being formed of the day or of the week or of the of the day or of the week, right? So having all these things taking all these things into consideration will help you give an edge and gives you a framework of what sell set or which setup should you be looking on a daily basis. Now, on a daily basis, it doesn't literally mean that you have to set up every single day. So you wouldn't literally print every single day. So what I was explaining before I realized that my mic was cut out was we've been on a downtrend since you see the market having a new high, lower, low, lower, high, lower, low, here, lower, high, lower, low, right? Now, when the market is forming a lower high and lower low, the market forms resistance point, which is the previous lows that are being created, is a very important part where we should focalize on, because the market will have a hard time breaking this previous lower low that has been created, because it will have a lot of resistance breaking that area. Now, the market can break this area if there's a high impact news that helps push this market aggressively, above, which can also be an excuse that the institution would use to deliver price rapidly towards the upside to seek for the buy side liquidity, and the buy stops residing above old highs that the market created when it was selling, creating the bearish trend lines, right? So these explanations could give you reference point where you want to be exiting some of your buy position if you are in these trades. Now, looking backward, the 60-day time frame, or the 60 days to the 40 days, the 20 days data provided by the interbank price delivery algorithm gives you an edge to cast forward where you think this market has a huge upside potential to deliver for the next second quarter, or for the next 60 days to 40 days to 20 days ahead. Now, on this liquidity, we have both buy side liquidity, which is for low resistance setups. Most of the times, when you see a sharp drop in the market from point, when you see a sharp drop from the market, for instance, from no, I'm not gonna take that. I'm not gonna take that, for instance. Let's have a new diagram drawn here. Let's say we have high or a little lower high, and it breaks, and it can, oh, sorry. See the market do something like this. Lower high, lower, new high, and then boom. And then it start trading above progressively. Now we would name this point C. I will call this E. Call this E. We'll call this area D. We'll call this other area A. B. So when you see a sharp drop, when you see a sharp drop from the market or in the market from point E to point D, there will be a liquidity void created, which means the market will have to refill this gap. Because when this market dropped aggressively from point E to point D, we had a sharp collapse in the market. Now that has created a liquidity void and an imbalance that this market needs to fill. Now, in as much as we hope that this market fill this imbalance, sometimes it wouldn't fill it rapidly. Sometimes this is not the end of the bearish movement. Sometimes the market would even dip deeper. But now, which reference point do you need to take into consideration when you see the market do such move and arrive to a solemn conclusion that this is the end of the bearish movement, and then the market is about to start creeping upward slowly but surely to refill the imbalance or the liquidity void that he had created with the rapid drop that the market did from point E to point D. So when it start moving from point D to point A, what you do is you wait for the market to break point A to point B. So a retracement from point B to point A would be a perfect entrance for you to target point C. This is point C. Now, why target point C? Point C most of the times is where you have a mitigation block, because remember, the overall bigger picture that we always say and that I always give you guys is for the institution to sell, they need to buy. And if they need to buy, they need to bring more buyers in the market to hope and to think that this market is about to go bullish before they crash the market. Now, when they crash this market, they still have a buy position open where the mitigation or where the buying movement started. Now, this market crippling into this gap feels south. Although they made money selling their position, this market creeping above the upside towards point C that we're explaining here fills the liquidity void that the market created while crashing aggressively, and give the institution the opportunity for them to offload their buy position at break even before maybe another bearish continuation or a bullish continuation, depending on the overall direction of buyers. So that is for a sell, that is for a buy side liquidity explanation that I could use so that you understand what a liquidity looks like. So sell side low resistance setup, we could usually do this and the reverse, or we'll have it in order for us to be able to save time. Now, the second topic of discussion of today, the quarterly shift. And the quarterly shift, we have the interbank price delivery algorithm data range, right? The interbank price delivery algorithm data range. Okay, these are previous comments. We have the interbank price delivery data range, which ranges from 6 to 4 months. 6 to 4 months major market shift. And we have smart money. In that 6 to 4 month market shift, we could have smart money accumulation for buy program. Now, what is smart money accumulation for buy program? Smart money accumulation for buy program would have to analyze these things. Now, if I were you, I'd be taking out note because this is very, very important. Understanding smart money accumulation for buy. Let me note it. One recommendation of a buy program, under which we have the dollar index makes lower low as the X makes lower low. The dollar index makes lower low, and the underlying makes a higher high. While the underlying makes, while the underlying makes a higher low. Now, the underlying could be any pair that is traded, any pair that is invertedly correlated with the dollar index. It could be Euro USD. It could be the USD Swiss dollar. It could be ASD USD. It could be gold. So that is the underlying. That is the underlying. The underlying. That is what describes this statement. Why the underlying makes a higher low. So you can replace the underlying maybe with the dollar index, or with the Swiss dollar, or with the AUD dollar, or whatever pair it is that you're trading. Now you'll notice that most of the time we're using USD/JPY as an example because it's the pair that I've been trading within a very long period of time. And I keep advising, and I would highly recommend each and every one of you guys to stick onto one pair and trade just that pair until you familiarize yourself with a lot of its movement, a lot of its market manipulation, and a little bit of everything that has to do with that pair. And even if possible, please marry the pair. Right now, I'm just being sarcastic, so don't take it personal. So, manipulation in the underlying versus the benchmark, and then we have the underlying. Underlining, which in this case would replace underlining with Euro USD, so that it make it easier. Underline makes lower low, while the benchmark or dollar index makes lower high. Dollar index makes lower low. Excuse me, dollar index makes higher high. While the underline makes higher low. All right. So this is literally what you could be using the dollar index towards your advantage for you to be able to make this analysis together or make sense. So when the dollar index makes lower low, the underlying makes a higher low, which means if dollar index is collapsing, the underlying should be looking for buy opportunities or higher highs in an indirect format. If the Euro USD makes a lower low, dollar index should make a lower high, which means dollar index should be looking for more bearish momentum. If the dollar index makes a higher high, we should expect the underlying to make a higher low. Now, these are data that you could use from the previous market data of a range of 60 days in a look back program of the interbank price delivery algorithm for you to be able to use the same data and cast forward where you think the market could be able to move within the next 60 to 40 to 20 days. Now, when we're looking backward, right? When we're looking backward, what do we look backward for? We look backward for, because on the interbank price delivery algorithm, the data that is provided is very important. For instance, USD has provided a significant data for us for the past 3 months. Look at how clean the bearish was. Now, there's a huge possibility that we could see a bullish spike. Maybe this month, maybe this two first month, for the market to seek for the buy stops that are residing above this old high that UJ has been creating while selling. I see. Yes, more like the dollar index is inversely correlated with UJ. No, the dollar index is not inversely correlated with UJ. Most of the times, the dollar index is inversely correlated with pairs that don't stack with the dollar. So, for instance, the dollar index could be inversely correlated with Australian dollar, US dollar. It could be, it is inversely correlated with the euro, US dollar. It is inversely correlated with the CAD, JPY. It is inversely correlated with which other pair again. But when most of the times the pairs that start with USD follow the dollar index as well. Most of the pair that start with the USD are correlated with the dollar index. But on the contrary, USD JPY and gold are inversely correlated. So when you observe the market, sometimes you'll see two pairs in this market that you could use them as dollar index, and a primary pair itself becomes your pair to trade, and you use the other as a dollar index. For instance, you could use gold as the dollar index for USD JPY because they're inversely correlated. But just because a pair is inversely correlated with another, it doesn't literally mean that it's going to respect it every single time. Sometimes they fail. And when they fail, the number one question that you need to ask yourself is what happened or what is going on. Or sometimes they don't only fail, but sometimes they start moving together. And that's when you understand that this is being institutionally sponsored and there's an aggressive move that's about to happen in less than no time. So you need to be able, or you have to be able to understand what the market is trying to do, what this data is providing for you, and how you can capitalize using this data towards your advantage. So back on point, when we're looking backward, trading using the quarterly shift, we want to catch the two things that you want to focus on. You see that we have a nice data provided, and this nice data provided is the data that we would use to cast forward. Now, while casting forward, we look backward. So the two key points on these quarterly shift, we have the look back, we have the look back, and the cast forward. All right, so we have the look back and the cast forward, which are the data that is being provided by the interbank price delivery algorithm. Now, when you look on the look back, what do you want to look on the look back? We want to look on maximum the 60 days data range that the market has provided using the look back period. Within these 60 days, which is equivalent to the first quarter, which is equivalent to 3 months, identify institutional order flow, among which you should refer the recent institutional points, which are old price high. You can draw a vertical line to it, and let's do it together here. So looking back, we see how I have a data range of 60 days. Now, these data, we need to analyze it in identifying institutional order flow and reference point of the institution, such as old price high, which is here, 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 all of this area. We could put a horizontal line there, this high, take another one, this high, take another one, this high, take another one, these equal highs here. Now, when you're looking backward using these data, another reference point is the reference to recent institutional reference point should old highs, old price low, which are these areas. We'll take another lines and put it here. I will change the color to blue. Yeah, blue. That'll work.
Pink.
What? Blue and another blue here and another one here. Great. Why do all these blue areas are points where the market could face a little bit of resistance breaking those areas because they are old low that are being violated, that created a bullish order block that was broken that has become a mitigation block. So those areas becomes a very sensitive area for the market to easily break it. So the market could actually dip into these areas and then have a little bit of retracement before gaining more bullish momentum to buy aggressively to the upside. So these blue areas should be areas where we should expect this market to have a little bit of resistance breaking these areas. Unless there's a high impact news, of course, that could help push the market aggressively. Now, you understand that with all the explanation that I've been using on this video, we have nothing to do with news trading. I don't teach news trading. We are not gamblers. There's a 90% chance that if you're trading news, you literally don't know what the market is going to do because you don't know how volatile the market will be, even if it goes towards your direction of bias. But now, having the bigger picture, you could be in the market on site, like before time, and be able to anticipate where the market is going to move within a specific duration. And then you position yourself 4 hours or a day before some certain high impact news. This class is going to end anytime soon, so I will send a new link. Don't worry about it. So having these informations actually help you as a trader to have where you think or a specific area or where you should be trading at, knowing that this market is moving towards this direction and me trading towards this direction is safer for me than looking for maybe a sell opportunity.